Hey, welcome to the Closing Beat, everybody. Happy Tuesday. How you doing out there? Good? Good. I see Victor P in the lead on the leaderboard. Is that client Victor P? Man, good job, Victor P. I haven't seen Victor P up on the list there. Is he, is that a first?
He's been around. He's
been around? All right. Just happy you're playing, Vic. But nice to see you in the lead there. Welcome everybody else to the Closing Beat. We talk about the stock market here, little lessons, educations, different way of looking at things. Hopefully, we're financial advisors, so we're always looking at the markets, unlike other advisors that play golf. I see them out there. You know what I mean? Like you call them up and be like, hey, man, you want to get together and talk and stuff? No, I'm on holiday. They're busy, but we are not. We are always here. And the summertime is really quiet because a lot of people go on vacation. So if you're thinking about joining Jazz, want to get started, test us out, see how it works, that's okay. You can do that. We are also going to be doing a Jazz World Tour. Well, actually, sort of subject to like the southeastern mid-United States. Believe me and Eric will be traveling to Georgia, Alabama, Louisiana, and Texas. Definitely Texas. We have a lot of clients in Texas. It's actually our second largest state. So we are likely going to be reaching out to you, coming out to meet you. Otherwise, we'll set up shop somewhere. Maybe you want to hang out. Come. I know we'll be in Houston and Fort Worth and San Antonio and all kinds of places. So we'll have to get together. If you're in the area, let us know. All right, let's take a look at the stock market here. So if we go over to the S&P, we got a little bit of a rally, okay? No problem. So we've seen this pullback. I'll call it kind of a rebalancing pullback. We alluded to this 2 weeks ago. We started seeing that happen there with the Russell 2000 sort of peaking up there and the NASDAQ just losing a little steam, at least the large caps in the NASDAQ losing a little steam because of the massive rally that they've had. But let's take stock of where we're at. Like what's going on here? So today, fundamentals move the market. Delta was a great example. I'll cover Delta here in just a little bit ago, or in a little bit. The durable sales numbers came out just shockingly to the upside there. Obviously, that's a bullish, optimistic sentiment type thing to see that, so we're happy with that. You got Darden Restaurants that basically said, we see no softness. When you're talking about softness, we see none of that, so we're not really concerned. That'd be ticker symbol DRI if you want to follow along. They said maybe we'll see some softness in fine dining in the first quarter. So you guys are out there spending your money. Carnival Cruise, they said margins are higher. The add-ons are higher. Premium services are higher, which kind of falls into the add-on space. Obviously, bookings are higher. Everything's good. Eric's going on a stinking Carnival Cruise here coming up. So he's obviously contributing to the pot. The point being that action today, that narrative, is what really helped the markets today, that optimism. Overall, though, let's do some pros and cons. Pros. We have a reduced recession risk. Anyone from Goldman Sachs to JP Morgan has a 25 to 65% chance of a recession by the end of the year. Goldman Sachs actually says more of a soft landing kind of a thing, so they're on my page with that one there. We have no debt ceiling issue. That's solved until after the next president, so no reason there, which means there's no credit risk issues as far as the U.S. is concerned. That's eliminated until after the next election. Bank failures, that's pretty much gone the way of I don't know, like fake meat, right? We're just not paying attention to it anymore. We're in that optimism phase of AI. That's probably a nice way to say it. Optimism creates a lot of money moving towards something really, really quick. We're all excited, and who cares about the valuations? We just want to pay it there. However, when you look at the stock market, you have to imagine that the upside is limited or kind of priced in, at least like 70% priced in at this point here. We have currently high valuations, not just here in the U.S., but around the world. If we take a look, on the far left, you're going to see the United States. Here's the 20-year range in blue, okay? The current forward price to earnings multiple is well outside of that range. It is in the 90th percentile. Look around the world, you're going to find a lot of things that are similar. Japan, where'd they go? Japan, there they are. So Japan is waking up over there. I don't know if you follow Japan, but it's getting better. That would be one of the more discounted areas that's still within a range to actually participate there. 19 times forward earnings there. We have confirmation of interest rates to be higher for longer. That's not my opinion. That's what the Fed said, that the interest rates are likely going to go up a tick more and then stay there for a while. There's no immediate reason for them to bring them down. They now have that flexibility to cut if they need to cut. So that puts a cap on things. That hurts large cap once the AI optimism phase is sort of fading away or gets out of the honeymoon phase. That's what we ought to call it there. We also know that participation in the market as far as stocks that are moving higher with the market is very narrow, limited, small, light, right? Those are the words people would use if you're looking this up. Here's the S&P 500 plotted on just a simple scatter chart here where I did year-to-date gains on both axes. Okay, so I did this so it would just show one straight line, so I didn't have to hand print all of these out and type them out. So basically, every stock in the S&P 500 is here. The trouble is these guys up here, your Meta, Nvidia, right? Ooh, right there. They're pulling the market up, and that's obviously evident by this and, of course, every other chart that we've shown. If you look down here, here's the zero line, and here's the bulk of the S&P 500. Some higher, some lower with a slight bias to the upside. And that's where the market should be there. Also, we have no earnings growth. You remember that? We have negative earnings growth in the S&P. The S&P's performance is driven by earnings expectations. If companies are going to earn more, they're expected to be worth more. If they're worth more, then their price per share should be higher. That's why people focus on the price of a stock relative to the earnings that they bring in. Well, a little bit of a disconnect here. Here's what we have. The pricing of growth does not reflect, in light blue, the actual growth. So the actual growth of stocks in the S&P is going down, yet we're paying more for them. That is not normal. You can see that growth relative to what is actually happening tends to be correlated. So in the very short term here, this is very early, but we have a divergence in what's going on. In other words, we're willing to pay higher prices for less product, less of a stock, less of a return on the stock there. So we put all that together, you go, I'm not saying the market can't go higher, but do you expect another 20%, 15%, 10%? Do you fear that you're about to miss out on that return? Is that possible when Nvidia is up 170-something%? Is it going to be up 400%? If so, that'll definitely do it. That'll help pull the markets right along there, right? But with all of that weighing on you, do you think that you're about to miss out on something? And let me throw out one more thing. The S&P is essentially, I can't back up a little bit. I don't know. I don't really know how to back up a little bit here. So if you were to follow this and go all the way back over here to June, you'd be right about here. The S&P is only 4% higher than where it was a year ago. I'm not complaining. I'm definitely not complaining. But it kind of puts it into perspective, right? That's not that impressive. We're only 4% higher. We spent the last essentially 11 months chopping around in a wide range that just got tighter and tighter. So think about things like that. Tends to put a little bit of a lid on your expectations going forward, and I think that's warranted there. The NASDAQ, I might mention, this would be its 35th day of being technically overbought by any technical measure that you want to use. Most people do use how many standard deviations is it away from its 50-period moving average there, which I don't have for some reason still on this chart. Now, 35 days, yes, that's a lot, but it's not odd, right? 53 days in 2021. 35 days in 2020, interestingly, right before a drop. And 53 days is the record, which is tied, right, for 2021 and 2017. So it is not odd for the NASDAQ to become elevated and then just stay there and kind of force you into buying at higher prices, but it cannot last forever. Other than that, yeah, that's pretty much what I wanted to cover. If we look at stocks in the news here today, I told you I'd mentioned Delta. You see that sucker? This one honestly got away from me. I was hoping to be a part of this, and I am not. So nonetheless, Delta up about 7% here today. Why? They have their investor day. Their investor day says, at their investor day, there was like 12 people that talked. Really fascinating. I'll show you a slide in a second. I might even do a separate video just on Delta here because this is pretty cool. Maybe Jazz After Dark. They're going to generate $3 billion in free cash flow, which they're going to use to pay off debts and continue to expand. That's up from $2 billion It's just $1 billion difference there. They expect that from 2024 and beyond, they'll be able to generate $4 billion in free cash flow. Imagine if you were to invest in a company, just let's say it's Jazz Wealth, and we produced $2 billion in free cash flow. And you go, well, that's awesome. I know I'm going to get paid back handsomely, right? And then I come back to you and I say, it's going to be $3 billion. You're really happy, right? And then if I tell you that next year it's going to go to $4 billion, so we're going to do a 100% return in 2 years, you're going to think something's wrong. You're probably going to go all around the internet there and tell people that something is not quite right with this company. Well, it is actually perfectly spot on with Delta, and they went through all kinds of reasons why you guys are spending so much money with them. Rightfully so. It's a great airline there. I just want to give you one stat. I won't waste your time with this today. You know the Delta SkyMiles credit card, right? You've been pitched one. You may even have one. This is not my news. This is right here from them. On slide 15 of their investor day, their Delta SkyMiles credit card, now the spending on those cards now represents 1% of U.S. GDP. Like, that's an impressive statistic there, right? That was a fun way to put it there. That's $233 billion floating around, going in and out of those credit cards. You got to be kidding me, man. That is just an impressive stat, I thought. So after everything that you see in there, I just thought that was really cool. They're actually going to be doing a lot more cool things as well. If you want to look into it, go for it. Now, I'm going to bring it down, right? I'm just going to take a little wind out of your sails here for a second. Starting to see other companies that are not necessarily tech related. The first one I'm going to mention is, but not necessarily tech related, downsizing, scaling back, laying off employees, vowing to spend less money. Okay. That goes in the negative column, right? You don't want to see companies downsizing. If everything's good and earnings are expected to grow, you grow. Go out there and invest in yourself. Robinhood. Robinhood's going to be I clicked on the wrong thing. They are going to be downsizing. Now, this kind of falls into the fintech space, to be honest. So this is not necessarily outside of tech, but you get what I'm saying here. Robinhood is about 7% of its full-time staff, so they're looking to bring down some of the costs there. Illumina also going to be reducing their expenses. You know what that means. By $100 million. That stock's obviously moving lower. Ford says that we're going to cut hundreds or more of salaried U.S. workers. So that's not good, right? They're supposed to be competing over there in that EV space. They didn't say anything about moving those dollars towards that. So got a couple names there. You go, that's not good. And likely Walgreens is about to start saying the same. You may have seen them in the news here today. You're not spending as much on your COVID care. I don't know how to say it. They made a lot of money from that. Not only from you coming into Walgreens and getting your COVID care, your, what do you call them, PPEs, the masks and gloves and toilet paper and all that stuff, but all the additional garbage that you bought when you were in there, right? And I fall for it every time. I go to pick up like a picture or something, I leave with gummy worms, right? So I get it. They're not making as much money on that because the foot traffic into Walgreens, not as much. You don't have as much reason to go there. And so they are likely ones to suggest that they're going to be scaling back as well. That's just a little bit, right? But that's one of those things that if you can pick up on that early and go, if I start hearing more and more about that, I get it that it may have been, layoffs may have been just kind of focused in tech, but now if it's spreading a little bit, I don't like the sound of that. That's not great. Higher interest rates for longer, everything that I just mentioned there. Can AI really drive us that much higher? I don't know. Hey, Jazz After Dark here tonight. We're going to be talking about some of the fun financial news that you missed while the thing sunk, the submarine. What's it called? Oh, the Titan. But what is that thing called? A submarine. Well, the submarine went to where we don't know where it went, but eventually we know what happened. Yeah, so we'll be talking about that here tonight. And then I'm more than likely going to go follow up through this Delta Investor Day thing because we have actually a lot of clients that work for Delta and just give you guys a heads up what's going on there, but some fascinating stats and obviously a fascinating presentation. So maybe we'll do that with Jazz After Dark and see what old Ed Bastian has to say over there along with everybody else. All right. For the rest of you, we'll hope you'll check us out later, Jazz After Dark and maybe Jazz Wealth. See? You'd see the logo there pop up. Enjoy. See you later. At Jazz Wealth, we treat you like family. That was going to be our slogan, but the employees here took it a little too seriously.
You bought what? That wasn't in the plan that I built for you.
Oh, quit crying.
Don't spend one more dollar.
I'm gonna start calling you Sylvester because you sound like a real.
Tú siempre estás llorando como un bebé, llorancito.
I'm not mad. I'm just disappointed. That's how you get your identity stolen.
We decided to go with let our family be your family's advisor.